Good afternoon. I'm David Walker, a longtime member of the McDonough faculty. Having a career in a top university offers unique opportunities, and we should never forget our flexibility and the freedoms we enjoy. My greatest pleasure at Georgetown is to work with students with infinite potential and distinguished colleagues. I'm privileged to introduce our keynote speaker, Dr. Michael Piwowar, Commissioner for the Securities and Exchange Commission, which has shattered its record for the number of enforcement cases in recent years. Michael was a research colleague of mine as a Georgetown MBA student a while ago, and he has become a distinguished public servant. Michael sacrificed a great deal to earn experience in academia and numerous public policy positions, which motivated President Obama to appoint him as a commissioner in 2013. After earning his MBA here and his PhD from the Pennsylvania State University, Michael taught at Iowa State University in Ames. He tells me he was in Ames last week and inspired the football team to their greatest win in history. Some of you may know they beat Oklahoma. I was a graduate student at Iowa State, and we dreaded when Oklahoma and Nebraska came in. We could always tell the football players because they were limping the next week. Michael has served as a senior policy positions with the U.S. Senate Banking Committee under Chairman Richard Shelby, whose wife was a McDonough School colleague for more than 20 years. And Michael has been a senior staff member with the White House Council of Economic Advisors. Michael's a leader in the financial world as an expert on Dodd-Frank provisions and an accomplished scholar on market micro issues. He's extremely generous with his time. He often meets with our students when he can. He's presented policy lectures in a wide range of forums. Nobody ever goes to Ames, Iowa by accident. If any of you have been there. And he meets with Georgetown students often. Michael, thank you for joining us for this afternoon's conference. My colleague, Rohan Williamson, chaired professor here in the business school, and just having finished a year as acting or interim dean, will moderate the session. So, guys, I'll get out of your way and be comfortable.
Thank you.
Okay. Well, thanks a lot, David, for this great introduction, and welcome, Mike, to Georgetown. Or welcome back, I must say. You have spent a lot of good times here, even from the early days of the business school back in Old North to this fantastic facility we're in now. And over your career, so you've kind of made different impacts. First, you started in the White House, then you worked with over on Capitol Hill. You were a minority member, a minority commissioner. You became commissioner. You spent a short while as the chair. So now, and you're back to your job now. So kind of talk to us about what's transpired over the years, what's evolved, and what's to come, especially given that we now have a new chair, so where are we now, and where are we going to be?
Sure, so thank you, Rohan. First of all, thank you, David, too, for that very, very kind introduction. It's always great to be back here and see you, who's served as a great mentor to me and continues to this day, so thank you very much. Everyone knows the one housekeeping announcement I need to do, my disclaimer. Any of the views I express are my own, do not necessarily reflect the views of anyone else at the commission staff, or my fellow commissioners. Sorry, now back to the question, right? So, so I've been a commissioner for going into my fifth year, so I've been there for 4 years. It's one position, but it's sort of really been 4 different jobs. The first job was I sort of viewed as playing defense and playing like a hard-nosed safety on defense and trying to stop some of the bad things that were happening with some of the Dodd-Frank provisions that I thought were not related to the crisis and took us away from our core mission. And then I was still in the minority, and we got down to 3 commissioners. And for those of you familiar with the quorum requirements of the commission, I had a little bit more leverage in terms of slowing things down. And so I felt like my job was playing prevent defense and trying to stop anything until after the election and see what happened. And then We happen to get a changeover administration, which means that I'm a Republican commissioner, which means I get to play on offense. And for about 3.5 months, I got to be the quarterback. I was like Tom Brady, although it was more like Jimmy Garoppolo because I knew Tom Brady was going to be coming in, and so I was only there temporarily. And I knew that we had a short time to get some stuff done, and so for the past 7 years, the work of the commission could have been summed up in 2 words: Dodd-Frank. And Dodd-Frank was passed July of 2010 in the wake of the crisis. Some things were related to the crisis, some things were not. Some things are working well, some things are not. But the problem was it told the SEC and the other regulators to do about 400 new rules, and we were responsible for about 100 of them. And so 99% of our time in the rulemaking front was spent on Dodd-Frank provisions. Now that the election has happened and we're shifting priorities at the commission, we can sum up the priorities of the commission in 2 different words: capital formation. We have a new chairman who's come in. His mandate from the president is to look at the public capital markets and see what we can do to get public companies to go public, get more public invested in the entrepreneurs of tomorrow. We recognize that fewer private companies are going public, they're staying private longer, fewer foreign companies are listing in the U.S. And so what can we do to democratize the investing in terms of giving everyday investors access to the next unicorns? Hopefully they'll be in the public markets rather than the private markets. So really could be summed up in terms of we're shifting towards a capital formation agenda.
Okay. And now over the past week or so, there was a Treasury report, and Treasury Secretary Mnuchin and his staff put out a report on regulation. So what's your view on this? How does that impact what the SEC is going to have?
Yeah, I was very pleased with the report. For those of you that don't know, this is a second in a series of reports that the Treasury Secretary was directed by the President to do, consistent with an executive order that he issued early in the presidency, to have the Secretary of the Treasury consult with the independent financial regulators and try to figure out what are ideas for changes to rules, regulations, and legislation consistent with 7 core principles. And some of those core principles are in the banking space, like never again too big to fail, protecting investors or protecting the system for systemic risk. But there's one in there that's focused on efficient, effective, and appropriately tailored regulations. And so they really took that to heart, and I was very pleased with the number of the recommendations to sort of have the SEC revisit some of our regulations there. They actually made some recommendations with respect to some legislation as well too. Recommended that Congress consider repealing 4 special interest disclosures that were put into Dodd-Frank that don't help investors at all. Resource extraction, mine safety, conflict minerals, and the pay ratio rule. For those of you that have been following what we do, those are highly controversial rules. They're incredibly burdensome, and so they recommended that Congress consider repealing those. They've also asked us to look at some of our rules and consider whether there's some burdensome regulations that we could potentially either have scaled regulation or exempt smaller reporting companies from some of the things like Sarbanes-Oxley, Section 404B, and some of those other things. And so we're taking a look at them. They have a lot of good recommendations in there. A lot of things in there are things that we had been thinking about anyway. We consulted on it with them, and we're very happy and pleased with it. And I'm happy, and I guess we're going to do a Q&A session. I'm happy to answer any specific questions folks have on some of those too.
Okay, that's great. So, but in aggregate, this is a move in the right direction.
Absolutely, and there was stuff in there on market structure. They sort of saying things that we were thinking about doing in market structure anyway. For those folks that are interested in that issue, we are working towards a tick size or a access fee pilot. It was something that I started directing the staff to do when I became acting chairman. We've been thinking about doing it. We're going to do it as a rulemaking. We're not going to do it as an NMS plan. We have the CAT, the Consolidated Audit Trail, I hear has come up in a number of different panels today, is done as an NMS plan. The tick size pilot is done as an NMS plan. We have less direct control as a commission over how those plans move forward, and so we're going to do the access fee pilot as a direct rulemaking, so we have more control over the process, and so look for that sometime in the future. Okay, great. Now, one of the issues you probably anticipate this sort of question, but this idea of cybersecurity.
Yeah.
So this is
obviously in financial services is a really big issue, and the SEC were, got a little bit of action from Congress recently about it. So can you? So what's your response to this general cybersecurity issue?
Well, thanks for bringing up a very awkward thing for me to talk about. No, just kidding. No, I'm happy to discuss it. Right? We had we're very public about the fact that we discovered that we had a breach in the testing part of the Edgar system in 2016. And you mentioned Congress, right? So Chairman Clayton, Jay, had to go testify in front of the House and the Senate shortly after disclosing this. And people forget that Jay, or Chairman Clayton, he's the hero in this. He's the one who, in the course of an investigation that he initiated, found out about that we had a breach back in 2016. That we found out there was a possibility of it, had him continue to look, found out that it in fact was true, immediately told Commissioner Stein and me. That's how we found out about it. And then immediately went public with it in a statement and also a press release, and then talked about it in Congress. And so he kind of got beat up for it a little bit unfairly. Like I say, he's the hero in this, and he's the one that's pivoted the agency, and we're very much focused on cybersecurity. He's got like a 5-part plan on how we're going to deal with it. We've got 3 investigations going on. We've got our IG and our Inspector General is doing an independent investigation. We've got an internal investigation so we can try to fix and mitigate any additional problems that we find. And then we're investigating whether there was any trading on non-public information in that. He's got the staff working on upgrading Edgar specifically, and then our cybersecurity profile more generally. And he announced that he's going to hire a chief risk officer to focus on these and some other risky issues. So that things aren't spread around the agency. We have one person who's responsible for these things, and so we're moving forward. We're going to fix it, and we've already fixed it,
okay.
and then make sure that there's nothing else out there that we don't know about, and make sure it doesn't happen again.
Okay, fantastic. Very proactive approach. So the new administration talks a lot about America First. And so, but there's something that's coming from across the ocean there that's flowing in our direction. That's this MiFID II that's heading in our direction, and some U.S., especially asset management side, are really concerned about how it will impact, in particular, the research component of what they're doing. And so they look at the SEC as probably the last big hope to work things out. And this is coming pretty soon. It's going to be in January.
Right.
So could you talk a bit about that, give a little bit of background and sort of where you guys are in
so we've had, over the last few months, we've had a number of industry participants come to us, recognizing this could be a potential problem for them and their business model. And our chairman, Jay Clayton, said we're not going to allow for the importation of problems from Europe to come over here. So we're going to need to work with our fellow regulators on the international level to see if there's things that we can do on that. In the meantime, we are talking to industry people in terms of, is there sort of a patchwork of, targeted sort of exemptive relief or those types of things that could help people out in this situation. All these conversations are going along productively. The initial conversations with the industry were a little erratic because we'd have different people come in. Literally, I had 3 meetings in 2 days, and people say, well, this is the problem we've identified, and this is the solution, and I'd have 3 different problems and 3 different solutions to people. And so industry spent a lot of time trying to figure out what exactly does this mean for their business model, and how does it affect what's going on in the U.S., and then what implications that has under our current regulatory regime, and then is there any sort of relief that we can do that would be targeted and effective for them. And my message to industry is, it's great. We've been focusing on the one issue that we've been focusing on is this unbundling of research and the payments and stuff, so it's not bundled in with other sorts of things. And we're working diligently on that. But MiFID II has a lot of other stuff in it, and we're hearing very little from people in terms of what other potential problems there are from MiFID II. Every once in a while, I hear a little bit of chatter, but if there's any industry people in the audience, go back and make sure that those other areas, that there aren't anything that that's out there that you think is particularly problematic that we haven't heard about, because it's October now, and to your point, January's coming. I don't want to be spending my Christmas vacation worried about the implementation of MiFID II. So, soon, come sooner rather than later.
Okay. Just to double back on an issue that came up earlier related to the cybersecurity issue. this idea that it may delay the consolidated audit trail.
Yeah.
Can you comment on that a little bit for us?
It's not going to delay the consolidated audit trail, full stop. As our chairman said last in testimony, we, the SEC, we're going to be taking the data from the consolidated audit trail. This is, as I mentioned, is an NMS plan. There are plan participants. There's a consolidated audit trail provider that are working towards hitting their deadlines, and that process continues. We, the SEC, are not going to take any of that data until we are confident and comfortable that we are, have a robust cybersecurity, a way to protect it. And so, while we are looking at trying to figure out ways that we're going to protect this to make sure that we, exceed the standards that are out there, that in no way affects the process. It's continuing to move forward.
Okay, good. So, we talked earlier about your evolution in your professional positions here. Now, there's a lot of things going on, a lot of changes from when things were evolving from Dodd-Frank. Is there anything else that is sort of out there that you kind of worry about, even though it's not as evident to the rest of us, that you sort of worry about?
Yeah, I mean, cybersecurity is obviously the biggest one. The other one is the competitiveness of the U.S. capital markets, and it's exactly what we're focused on, right? We've always been, the place where people come to list. And if you think of, foreign companies would, want to come here to bind themselves to high-quality accounting standards, high-quality regulatory standards, high-quality legal standards. And the fact that we're seeing fewer companies come here, and in fact, companies actually shy away from the U.S. capital markets is problematic. And if you think back to before the crisis, and I know, for the last, it's 9 years since the crisis, 7 years of Dodd-Frank, that's all people sort of think about. But think back to, in the mid-2000s, right? What were we worried about? It was the competitiveness of the U.S. capital markets. So some of these things were, it's like the canary in the coal. We were starting to see some of these things. And then we had the financial crisis and people forgot about it. And so now we're returning to these issues. And so how can we make, the public markets attractive to, to smaller issuers that then people can invest in? And, as I mentioned, the private markets are doing quite well. But the average everyday American can't invest in those private companies, right? The world is divided up into what we call accredited and non-accredited investors. And accredited investors are people that are supposedly have a high level of sophistication, which we define as if you're rich, if you have a high enough net worth or net income. You're allowed to invest in private equity and some of these other private securities offerings, but the average American can't. They only have access to the public capital markets. And so while it's fine that some of these companies have access, there's an excess of capital in Silicon Valley right now. The average American is not sharing in those things. And the other thing that we're starting to focus on is we call the geographic diversity in terms of the financing that's out there, right? We were talking about this earlier. It's something like 75 to 80% of all venture cap financing occurs in 3 places in the U.S., New York, Boston, and Silicon Valley, right? And there's a heck of a lot of the rest of America that is not getting access to this VC funding, and there's a shortage of it. And so where there's pockets where there's excess capital, there are other pockets where there's not. And so what can we do to try to think about, what can we do to help unlock the entrepreneurial spirit of some of these folks so they get first the private capital financing and then become, tomorrow's public companies.
Great, thanks a lot. So now we'll move into our Q&A session. A couple of rules of the game here. So in the interest of time and to make sure everyone gets an opportunity to ask their question, please try to keep your question as succinct as possible to give everyone an opportunity to ask a question. So there are mics there. So let's get started with the questions. And
okay, thanks, Commissioner. My name is Li Yang. The way you present is something you try to think the Democrat is the fault, and you oppress the GOP. But I think probably both sides are wrong in most of the issues. For instance, GOP is just sort of more basically.
Are you going to get to a question?
My question is,
This
okay, how are you going to do something to protect our people based on our Constitution so their property and rights will be all protected so they can really invest and prosper and with very well protection of their well-being and productivity?
Okay,
thanks.
go ahead. Thank
Yeah,
you. Thank
so
you.
as you know, the SEC's mission is three parts: protect investors, maintain fairly and efficient markets, and facilitate capital formation. And we protect investors in a number of different ways. We write rules to protect them, we monitor compliance with the rules, and we enforce those rules. Every single week we have closed commission meetings where we vote on somewhere between 10 and 20 enforcement actions. We have investor education materials that we put out there, and we're a disclosure agency. We make sure that material information is disclosed to investors to protect them adequately. Thank you.
Okay. Thank you.
That's
Okay.
why I say
Excuse me,
I would
excuse me.
rather present more evidence for you so you can resolve it.
Okay.
Thank you.
Thank you.
One of the points that was raised this morning was the burdensome nature of quarterly filings. Not every jurisdiction requires quarterly filings. What do you think of the idea of a pilot of taking a control sample of firms and relieving them of quarterly filing obligations, having some with semi-annual filings and some with only annual filings? And then, with a good controlled pilot study, you can actually see the impact of different filing frequencies to come up with an optimal disclosure regime. What do you think of that idea?
It's the first I've heard about it. It's interesting. I mean, it's when I talk to these private companies, these unicorns that don't want to go public, there's a whole list of reasons, and this focus on quarterly filings is one of those. Now, companies can voluntarily choose not to participate in certain quarterly guidance and all that sort of stuff. But you're talking about the 10Qs themselves and do all that stuff. That's an interesting idea. Now, as much as Jim, as much as I love pilots and the data we get from them and we think they're good and stuff, but they are really good public policy tools in certain instances, and have to think carefully whether it would be appropriate. I mean, it would have to be a very long-term pilot.
Yeah, probably 5 years.
To get the data from this stuff. I'm trying to think of the power, the statistical size and power we need to do that test, but it might be interesting. Yeah, and an opt-in wouldn't work either, but yeah, interesting.
Okay. We'll go here and then on this side.
So on the topic of capital formation, this is a legit question. I have no agenda here. A lot has been talked about the differential between public and private companies. We get that. I haven't heard a word about either OTC securities or ICOs as a mechanism. Now, obviously, there are issues on the ICO side, complete Wild West, no regulation, I get that. But do you see the use of blockchain-enabled ICOs and also extension of, and I know Cromwell's here someplace, and he did not put me up to this, an extension of OTC securities as a way to bridge that gap? Because I don't hear a lot talked about, but frankly, it exists. There are thousands of securities, and it's a less onerous system.
Yeah, I mean, we already have that system, right, that's out there. And you mentioned initial coin offerings. This is one of these areas, it's interesting. FinTech in general is an area where we're going to have to be spending a lot more time. In fact, we already are. We have a FinTech task force. We're trying to keep up on this. We just issued recently, earlier this year, what's called a 21A report, or a report of investigation related to an initial coin offering. And this is a report, a statutory report that we could issue after an investigation, either in conjunction with an enforcement action or instead of an enforcement action. We decided to do instead of, in this case, determining that a particular type of ICO, it was called the DAO, was in fact a security. And so it was focused on that specifically, but it was also meant to be, and we've gotten good feedback on this, is to give people sort of a roadmap of how we think about ICOs as, should they be registered as securities. And it turns out the existing laws, the existing regulations, the existing court cases, something called the Howey test and the Reeves test, or the ways that, for these court cases, viewed through those lenses, ICOs could use whatever acronyms they want or buzzwords they want, but when you look through and you get through the economic interest, in a lot of cases, I can't say most or all, because I don't know which ones are all out there. Many of them are securities and should be registered as such. And so as a follow-on to that, we also put out, you mentioned the Wild West, we put out an investor alert on these things as well too. And then the third piece we did was our chief accountant gave a speech where he talked about some of the accounting issues. If these things are in fact securities and they have to take into account generally accepted accounting principles, what are your obligations under those types of things. So.
Sarah, yeah?
Hi, Commissioner. I just want to let you know, I think you're doing a great job, and I also had a chance to meet one of your predecessors, Christopher Cox, real good guy.
Oh, yeah.
But I don't know if you're allowed to, if you can't, just say, no, I can't comment on a rumor that, again, it was brought up earlier that a SOE or some kind of Chinese national or Chinese investment company is looking to buy a small stock exchange in Chicago. If you're allowed to say anything on that rumor, if not, I understand.
It's not a rumor, it's public knowledge. There's an investor group that wants to buy the Chicago Stock Exchange, and it's currently before the commission in terms of reviewing. So I can't comment on, it's going to come before us on whether we approve it or not in accordance with the statute that we have. And so. Yeah.
Thanks, Thomas D. with Capstone. An issue that wasn't mentioned very much in the Treasury report is private equity and private funds. But it's obviously an area where the SEC has done a lot of work over the last few years, both in terms of implementing the changes in Dodd-Frank and also in terms of enforcement. So just curious what your priorities are sort of looking forward, and whether you would support any legislative changes to exempt certain private funds from SEC registration.
Yeah, I can't remember if that made it into the report or not.
I don't think so. It might be in the asset management one, which is coming up.
Yeah, I mean, in terms of, we have we got our appropriations from Congress, right? So they set the level of appropriation. We collect fees in order to offset that, so we're budget neutral, but they're the ones that set the level of appropriation. So we have a limited set of resources in terms of where our areas of focus are going to be, right? So when it comes time for, compliance and enforcement cases, and even regulations, private funds are sort of way down on my list, right? These are arguably the most sophisticated investors dealing with general partners who are also sophisticated, right? Our new chairman, he talks about, thinking through the lens of how would this benefit Mr. and Ms. 401k, right? So the average investor, the everyday investor, and so we're going to make choices in that. And so, just speaking for me personally, I would spend less resources in the private fund space and more in how we can help Mr. and Ms. 401k.
Thanks.
Yes, sir.
There's been prevalence of crowd investing so I was wondering if the SEC has any thoughts on whether the accredited investor limit will go down for crowd investing, and also I wanted your thoughts on cryptocurrency and regulation. Cryptocurrency.
Yeah, so the cryptocurrency, so the currencies themselves, the Bitcoins themselves, and Ethereum and those sorts of things, we've not determined that those are securities. My own personal opinion is, if you look at the definition of securities, banking product, foreign exchange, commodity, it fits commodity. But there are things that you do with those Bitcoins, like initial coin offerings, right, that once you run through, then those become securities. There are Ponzi schemes, there are unregistered exchanges, those types of things that we regulate. And so we're constantly looking in that space. You mentioned crowdfunding, and what was the question about?
Crowd investing and the fact that non-accredited investors.
Oh, yeah. So you're talking about the fact that we did regulation crowdfunding, and we limited the amount that people can invest in those based on their net worth or their income. Yeah, I would, if it was up to me, I would raise those limits, right?
Raise those limits? Okay.
Yeah, so the statute was ambiguous. So it said we had to look at net income or net worth, and it was ambiguous as to whether it was the lesser of the two or the higher of the two. And so I would open it up to more potential investors. Regulation crowdfunding it's not showing the promise that people wanted to have, and I think a large part is because the statute is very prescriptive, and it didn't give us a lot of flexibility at the commission in terms of to make it, to open it up to allow for more capital flow. And so I'm not sure how ultimately successful it's going to be without Congress going back and changing that. Now, interestingly, crowdfunding can occur at the state level in intra-state offerings that don't even opt into the federal offering. So there's exemptions that allow, DC resident, DC issuer for DC residents in Virginia and Maryland or whatever, as long as you stay within your state. Now, it used to be you could not offer or sell the securities across state lines. we changed that. We got rid of the offer prohibition, and now you can't just sell across state lines. Why is the offer important? Because now people can use the internet. Because before, if you were to say, hey, I want to sell my securities to residents in my state, right, and you put it on the internet, well, then you actually were offering across state. How can you prohibit? We've gotten rid of that prohibition, so we make it easier. So different states have different crowdfunding regimes, and so folks that want to look into that, they can potentially find one that's a better fit for them than the federal regime.
That's pretty cool. Thank you.
Yeah.
Dave Michaels with the Wall Street Journal. So in light of what you said about...
And Georgetown graduate.
And Georgetown graduate twice.
So you can ask a question then before that. We wouldn't let you do it.
So in light of what you said about the CAT, no delay on CAT because of cybersecurity worries, at this stage, would you support reopening either the rule or the plan to exclude personal information of brokers' customers from the reporting requirements? As you probably know, the exchanges have been pretty insistent that they don't think personal information should be included in the CAT, both for cyber reasons and for practical reasons.
Yeah, so to be honest, I haven't thought about that particular issue, reopening it to consider whether or not, because the order was already approved with that already in there, right? So my concern all along has been, if we're going to do that, we need to make sure we have the adequate protections. And in fact, when we did the open meeting to approve the final order, I specifically asked our Division of Trading and Markets Director and our General Counsel to speak to that issue, because people had brought up the fact that with respect to PII and a lot of the other issues, the Commission, we were not holding ourselves to the same standards as the plan participants. And so the General Counsel was able to say, well, we're a government agency, so we can't, but we have our own standards that we will do. And then our Trading and Markets Director was then able to talk about the specific standards that we are going to hold ourselves to. So hadn't thought about pulling out PII, but to the extent that it is in there, we need to make sure before we take any access to any of this data that we are confident that we're going to be able to protect it.
Okay, we have time for one more question. Okay. Yeah.
Thanks. Ben Bain with Bloomberg News. I just wanted to ask about the general rulemaking schedule going forward. When you were acting chairman, you were a critic of some of the Dodd-Frank rulemakings in that tenure. So now that we're back at kind of three commissioners, do you envision going forward with any of those rules, particularly the swaps rule and some of the derivatives rules that were unfinished? Do you think that's in the agenda for the rest of the year or into next year?
Yeah, so be clear, the chairman sets the agenda, right? And we will be going forward, or he will be putting out what's called the Reg Flex agenda, which we publish, sent to the White House and publish in terms of sort of a roadmap in terms of long-term rulemakings and that sort of stuff. When I was acting chairman, I announced we're going to take a pause on Dodd-Frank rulemaking until we sort of figure out what direction Congress was going to go in that. I'm not hearing that Congress is going to do anything big in Title VII in the derivatives rulemaking. The CFTC has moved forward. They've indicated that they might want to revisit some of their rulemaking. The Treasury report that came out last Friday in this space said that we need to work together to harmonize the rulemakings. And we talk about international harmonization of regulators, right? We haven't done a good job harmonizing domestically, and I think there's a real opportunity for us to work with the CFTC. Just me personally, we'll work with the CFTC to harmonize some of those derivatives rulemakings and give people the certainty they need in that space.
Okay.
Yeah. Now, in terms of rulemaking, we have an open meeting tomorrow. We announced it's going to be on simplifying and modernizing what's called Regulation SK, just cleaning up some of the disclosures that public companies have to do. So hopefully getting the 10K report from this thick to maybe this thick, on those. And so we're going to do that, and then the access fee pilot we've been talking about doing. We don't have a specific date on that one yet, and then the chairman will announce some of the other things. But I would imagine that the derivatives working with the CFTC is the right direction to go.
Okay. Thanks a lot, Mike. And we really appreciate you showing up again.
Oh, sure, anytime.
To the conference, and I'll turn things over to Rena. But you continue to make us proud, or is it? Okay, make us proud as a Hoya. I mean, David didn't mention that's the most important part of you. That I'm an Ohio State guy, so that Penn State thing doesn't impress me at all.
We'll talk in 3 weeks.
Okay.
Yeah.
Great job.
Thanks.
So everyone, thank you very, very much. And I want to just give you a couple of closing comments here. First off, I want to thank everyone for coming. I want to thank, obviously, our keynote speakers today, starting with Mark Makepeace all the way through Commissioner Piwowar. Great lineup. The panels are great. There's a lot of great information that we learned and shared, and a lot of great networking that occurred here. I did want to point out, Jessica, would you stand up? So Jessica Diffess is the assistant director for the center. She's the one who actually does all the work here. There's like 3 of us at the center. There's Rena with the vision, and she's in charge of it, and she's the one who tells where to go. Jessica does all the work, and I take all the credit. So it's a really fair distribution of labor. So no, I also want to thank the Georgetown team, because from everywhere, from the tech guys up there making sure everything worked, to the marketing team and Chris and Molly and Teresa and everyone making sure they had all the materials. It's been a great team effort here. There's a lot of people behind the scenes that made this happen. And so now the fun part, we have a reception upstairs and with a bar and some food. And so we'd like to end it there. Bart? Where upstairs? Right out the door. Jim, you can't miss it. It's right upstairs. And lastly, we will follow it up with you. We love your feedback. So anything we can do for next year, let us know. Thank you very much.